and stuff.
Right. Looks like we may be getting ready to start.
Mhm. Hey, RG, I think we're good to go. I think I just got a little message that
Okay.
we're up and
Yeah, I
running.
didn't see that. All right. Thank you, Thomas. Um, Hello, everyone. I'm RG Earnest, and I'm with the Low Income Taxpayer Clinic of Legal Aid of Arkansas. And I'm here today with Mr. Thomas Toft, who is with Legal Aid of Western Michigan. And in our clinics, Thomas and I regularly help retirees and senior citizens with the unique tax issues that they face. In today's presentation, Thomas and I will discuss some of the issues that we commonly see. Um, we're going to start our presentation with basically a summary of the tax benefits and return filing requirements for retirees and senior citizens. And then at that point, we're going to move on to discussing tax issues like withholding, the specifics about retirement accounts, and some other tax issues as well. So to start off, tax benefits of being a senior. The tax laws don't change much for retirees or seniors, so you might still be required to file tax returns and pay taxes. But what does change is how retirees and seniors will get money and how much they get. And this may change the way that a retiree or a senior is going to comply with the tax laws. That being said, there are certain tax benefits to being a senior, and those include that your standard deduction is a little bit higher, your filing threshold is a little bit higher. There is a now under the new tax law that just came out, there's a $6,000 deduction for seniors who are 65 or over. And that deduction applies regardless of whether you itemize on your tax returns or not. There is a credit that sometimes will apply to elderly people, but that typically just applies to very low income elderly people. And finally, there's also there's a special Form 1040 that seniors and retirees have the option of using. They aren't required to use it, but sometimes it's easier to use that 1040-SR. And so they can use that if they are old enough, 65 or above. At this point, I'm going to hand things over to Thomas, and he's going to discuss a little bit more about the tax benefits or some of the other tax benefits that you can see when you're a retiree or senior citizen.
Thanks, RG. So one benefit is that often at the federal level, your Social Security is not taxed, but it's important to talk about really Social Security benefits may or may not be taxable or partially taxable, depending on what's called combined income. So we got to talk about this first. Because what happens sometimes with folks that reach out for assistance is, they're retired, they're just getting Social Security retirement. They take a little job on the side to do something, got some other income going on, and they don't realize it's like a tripwire. They make too much other income, taxable income, and all of a sudden, some of your Social Security that wasn't taxable becomes taxable at the federal level. So first, I want to talk about this combined income that you can see here on the slide, where combined income is your adjusted gross income, or AGI, plus non-taxable interest, plus 50% of your Social Security benefits. You add those three things together, and that becomes what's called combined income. And then you look at how much combined income you had in a year, and that determines, depending on your filing status, whether any of your Social Security is going to be taxed or if some is going to be taxed, how much. Like, for example, if you're a single status filer and your combined income is less than $25,000, well, you're going to be good. Your Social Security benefits are not going to be taxed at the federal level. If you're a single filing status taxpayer and your combined income is between $25,000 and $34,000, all of a sudden half of your Social Security benefits are going to get taxed at the federal level. And if you're a single status filer and your combined income is over $34,000, 85% of your Social Security benefits are being taxed now. And then you can see below this, it's the same type of levels for marital filing joint, so a little bit more generous. The point I'm trying to drive home is if you're getting Social Security benefits like retirement, you need to be aware of what combined income is and how much other income you're making during the year so you don't get through the year, go to file your return, and you get a surprise. Now you might get less of a refund of your old tax because of these rules. This is the federal level we're talking about. There's also the state level. In Arkansas, your Social Security benefits are excluded from income, and that state doesn't tax the first 6,000 of certain retirement benefits. In Michigan, we don't tax Social Security benefits at all. For other types of retirement income, and we're talking like IRA income, 401ks, 403bs, pensions, there's a tiered system based on your birth year. Is a little bit much to get into now, but you need to be aware of this if you're in Michigan. With a tiered system for the 2025 tax year, which is the year we're in now, and these returns will be filed starting beginning of 2026. A shorthand of it is that if you were born before 1946, 100% of your benefits, these retirement amounts are going to be exempted from state tax. If you were born from 1946 to 1966, then 75% of this other retirement income is exempt. And then if you're born after 1966, nothing's going to be exempt. That's for 2025. In 2026, the end of this phase out period is in, and basically all retirement income is going to be exempt. And if you're curious about that and you're watching this, you live in Michigan, just go to Google, type in the Lowering Michigan Cost Plan. It's Public Act 4 of 2023, and it has all the details. You can get lots of hits. So we have a tiered system. But these schemes about what's taxable, not taxable, or in general for the federal and state level, benefit seniors and retirees over people who can't enjoy these breaks. So just want to make everyone aware of this. You got to know how much you're getting in benefits and how much income you're getting that's other than those benefits, and figure out if you fit in any combined income that's going to cause you to be taxable at the federal level, and understand your state taxation of retirement income, particularly this tiered system in Michigan. All right, RG, I'm set with all that.
All right, thanks, Tom. So now we're going to talk about filing requirements. And there's the first and most important question you have to ask is, do you have to file? And it really depends on what Tom just talked about, which is depending on what your combined income is. And he explained how you calculate your combined income in the previous slide. And so we have these filing thresholds, and I set out just a couple here, the two main ones. If you're 65 or older, you have that somewhat higher filing threshold. If you're single, your combined income would need to equal or exceed the 16,500. I think it may be 16,550. And if you're married filing jointly, it's higher, of course. It's 32,300. Now, there are other kind of filing statuses that you might qualify for as a senior. Those include head of household, married filing separately, which has an extremely low filing threshold of just $5. And then there's also qualified surviving spouse. And so those were, you would need to determine whether first off, kind of what your status is going to be. Again, the most common is single or married filing jointly. But your status, say married filing separately, that it creates a different filing requirement for you. And the final thing for me to note is that if you receive self-employment income, you will usually be required to pay self-employment taxes. And the filing threshold for self-employment taxes is actually quite low. It's just $400 of, well, it's net earnings. It's based on your net earnings. So if your net earnings exceed this $400 threshold, you would need to file. So that is something to keep in mind. I mean, there are a number of retirees and seniors out there who are doing some side gigs and they're getting 1099s. And so it's something that you would need to be mindful of whether or not you would owe self-employment taxes because of your 1099s. And now I'm going to hand it back over to Tom, who I think is going to talk about when you might want to file your tax return, even if you don't have to.
All right, thanks, RG. So what I want to talk about is the possibility of refunds. And let's just say you don't want to leave money on the table. Every year I got folks that come in and they're in the situation when they didn't have to file a tax return, so they didn't. But if they did file a return, they would have got some money. So we see this a lot when there's a possibility of refunds from withholding on wages. Say you work a job, and say you maybe get like 20 grand, Social Security, retirement. You take a part-time job, you make like $5,000 or $10,000 during the year, and out of those wages, you had federal tax withheld. Well, you get to the end of the year, you figure out your combined income, look at your filing requirements. You don't have to file a tax return, right? But what about that withholding they took out? If you don't file a return, you're not going to get it. In order to get that money back, you're going to have to file a tax return and get that withholding back as a tax refund. So that's a situation you don't have to file, but you really should to get that refund back from the withholdings that you had. There's also credits. Let's take the same type of example. You have Social Security retirement, maybe 20 grand, you take a job making, say, $5,000, $10,000, Even if you didn't have withholding, right? You had no federal tax withheld. All right, you're good. You don't have to file. You don't have any withholdings to get back. But there's something called an earned income tax credit the IRS has. And if you're a lower income individual and you get out there and work or have some self-employment, there are credits you could qualify for where they say, hey, because you're out there earning some income, we're going to give you some money back. Well, how do you get that? You got to file a tax return. And those are just talking about some examples like a earned income tax credit at the federal level. I've got to say the state has tax credits also, both Arkansas and Michigan. For example, I know in Michigan we have our own version of the earned income tax credit. The same thing about withholdings. Maybe if you had federal withholdings taken out on a job, and there's also state withholdings. Well, even though you might not have needed to file, you should to get that withholding back as a refund at the state level as well as the federal level. And there are other state tax credits that come to mind. Like here in Michigan, we have a homestead property tax credit where you could have just Social Security income, nothing's taxable. And if you, there's certain rules, but in essence, if you are owning a home and you have property taxes assessed on it, or if you even rent and under a contract agreement to rent and have lived in the state long enough and are under a certain income levels, you can file a state return in Michigan with no taxable income at all and get hundreds and even over $1,000 back from what's called the homestead property tax credit, kind of to give back some of the property taxes assessed on your home if you own it. Or if you rent, the theory is that your rent goes to the landlord and the landlord pays the property taxes. Well, it gives back some money to you to kind of, in a way, compensate you for some of that indirect property tax that you paid. So there's a lot of times I've got folks that come in that just don't file. They're like, hey, I get Social Security. Don't have any other jobs on the side. I just don't file returns. Well, we look at it and they qualify for this homestead property tax credit. And in Michigan, you can go back 4 years, past 4 years, you didn't do this. If you qualified, you can file it and get caught up and say it's like $500 a year for the past 4 years, $2,000, just going back and have those returns done. So, that's the homestead property tax credit. We have a home heating credit that's a little bit different, but there are state tax credits that you might not think you're qualified for because you don't file returns. I have a filing requirement, but you really need to file those returns to get those credits and get those refunds. So it's important to understand your state tax credits. That's a real common reason that we have folks come in and they're like, hey, you don't have to file, but you really should. And we get into all the details and help people with that. Something else that is a good reason to file when you don't have to is for identity theft concerns. If, say you're retired, got some Social Security benefits, maybe work a little job on the side, but you don't have a filing requirement, you really don't have a other reason to get like refunds back, so you just don't file. Well, at the IRS, every year, they don't have a return on file in their system, right? It's a lot easier for a scammer, a fraudster, if they get your information to concoct a fake return and electronically send it to the IRS. And if there's nothing there from you, it can just take it a lot easier than if you had filed. It's a little hard to explain, but if there's a return that you file every year, just a informational return, or just some very low dollars on wages you made. If there's a return you file that's in the system, if a fraudster tries to e-file on top of it, it's going to get kicked back. And then the fraudster's got the situation when he wants to really scam on you that way, he's going to have to mail the paper return in, and they virtually never do that. So some folks like to file every year, even though they don't have to kind of keep that the IRS records, the systems populated with a return every year. Now, somewhat recently, and we'll talk about this briefly later, another way to protect yourself, if you don't want to file, go through the hassle every year and you don't have a requirement, there is something the IRS has called an identity protection personal identification number. Oof. We call it a IP pin for short. But anyway, we'll talk about it later. You can apply for it with the IRS. And what happens is once you do that, the IRS will send you a number. I think it's 6 digits, 5 or 6 digits. They send it to you every year. And if you don't have that number for the filing season you're in, the most recent number they issue to you, you cannot electronically file a return. So by doing that, if you apply for an IP pin with the IRS, and now you're enrolled in it, even if you don't file any returns, and a scammer wants to create a fake return with your information and try to electronically send it to the IRS, well, because the scammer is not going to have the IP pin, the IRS will reject that e-filing. And are they going to send a paper return? Probably not. So it's another way you can protect yourself. We can talk about it later, but I want to mention that as well, since we're talking about identity theft concerns. Now, do you have anything to add, RG, or?
No, not right now, but I do. I do. I mean, I second your thoughts about the IP pin. It is a great way to protect yourself from identity theft issues. And like you said, one option is to just file tax returns regularly, even if they're $0 taxes due. The other is to just apply for one of these IP pins, and those can give you protection as well. Um, Now I'm going to talk some about uh, how you file a return. So say that you've determined that you have a filing requirement, or you've determined based on some of the reasons that Tom just discussed, that regardless of your filing requirement, you should file in order to protect yourself from identity theft or to get refunds. You have a few different options. I think one of them that we wish more taxpayers knew about, especially retirees and senior citizens, are these IRS grant programs, often called VITA clinics. That stands for Volunteer Income Tax Assistance. There's also a version of a VITA called a tax counseling for the elderly program, and that is typically administered by the AARP. And so it's kind of obvious from the name that the counseling for the elderly program is more targeted towards senior citizens and retirees. It's for ages 60 plus. If you are a senior citizen or retiree, you can certainly take an advantage of a VITA program as well. It has a kind of these are income threshold based programs, especially the VITA ones. Um, but the AARP ones, I think, are a little bit easier to qualify for these free services. And the advantage of these are that you get free tax return preparation from people who really do know what they're doing. And so you're going to get, or will almost certainly get, an accurately prepared tax return, and it won't cost you anything. If you want to know where they're at, the IRS has a locator tool. If you just get onto irs.gov and search within there for the VITA locator tool, you can type in your zip code and it will show you where the nearest VITA clinics are. AARP also has a locator tool that you can use for their clinics. Um, if you feel comfortable preparing your own tax return, you can take advantage of the IRS free file program. Again, the IRS, if you get on its site, it will show you the companies that it is contracted with. Um, that will allow you, depending on your income, what will allow you to prepare a tax return on their software for free. So that's an option. And then, that your final option is what you might, a lot of people already know about, is to find a trusted tax return preparer. And if you don't have one already, there's also a locator tool on irs.gov where you can find people in your area who are either that they're somehow um, uh, signed up with the IRS or licensed or recognized by the IRS. It's typically going to be a CPA or an attorney or an enrolled agent. And you can find them by using that locator tool. And it is a good way to find a reputable tax return preparer in your area. And I think, Thomas, you have the next slide. Is that right?
Oh, yes, yes, RG. So let's talk about forms. Now, where I see issues are someone doesn't have a form that they need for preparing the tax return, or they just leave it off. Like they miss it in the mail, it doesn't come, but they probably should have known it was coming, or they get it and they're like, I don't have to put this on the return. So I want to talk a little bit about common forms and kind of discuss what they are, so folks can be aware of them and know that you really want to have these and need these to properly do a tax return. There are forms W-2s and 1099s. A form W-2 is simply a form when someone pays you for something like wages, they will send a form W-2 at the end of the year showing how much you made and how much your withholding was and all these deductions. That's used to go on the return. Also, there's a W-2G as in good, which is used for gambling. So if you gamble a little bit, hit some wins, you might get a W-2G as well, right? 1099s, well, there's a ton of them. I think there's over 20 at this point. But that's when you get payment from another third party, but it's not wages or like gambling income. It could be a type of 1099 from the government. It could be a 1099 for miscellaneous income. It could be from payment settlement entities. There's a bunch of different types, but if you see 1099 tax form, you're going to want to keep that and make sure you use it for your tax preparation or bring it to a tax preparer, even better, if you take advantage of what RG mentioned on the previous slide. There is the SSA 1099 I want to talk about specifically. That is if you get Social Security retirement benefits or Social Security disability benefits, at the end of the year, it'll send you this form called an SSA 1099 showing what the benefits were. And if you get any withholding in it, you chose to do that, it'll be on there. And that's how you have the documented amount of how much of those benefits you got in the year. I should mention a real common 1099 called a 1099-R. R is in retirement. If you have, say, an IRA and you take some of that money out at the end of the year, the company that manages that IRA is going to send you a 1099-R showing what income was taken out during that year. You know, it'll indicate if it's tax or not, depending on the type of IRA it was, and if there's any tax withheld. Now, I got to mention, a lot of the time, not a lot, but frequent, we'll say, that's frequently, we'll have someone that will come in and they will have gotten a 1099-R and they'll look at it and go, oh, well, there's some money I took out. I just retired and I cashed out a lot. So I got some money out. Oh, and there's tax withheld. I'm good. I don't have to worry about this form. They took the tax out and they will just disregard that form and put it to the side and either not file a return or they won't include it on the return that they do file. And I got to mention that these companies that manage these retirement accounts, IRAs, 401ks, 403bs, usually when they have a withdrawal and there's taxes taken out, it seems to me, and tell me if you see something different, RG, it's like 10%. They take 10% of the amount and say, hey, this is a withholding. That's just their guess. They're saying, hey, we're going to take 10% out. So there's some withheld. But you know what? You don't really know how much tax is owed on that until you get to the end of the year and you actually do the return calculations. And usually it's not enough. So if you get a 1099-R and there's tax withheld, probably going to be 10% of what the withdrawal was as the tax. Don't just set that aside or assume that everything's good, because you still need to take that form and use it in your tax return preparation. And there's for a lot of folks, they end up having to pay a little bit more in tax on withdrawal, depending on the other numbers. But you got to be aware of this. These forms come in, don't just set them aside. And if you did withdraw money from an IRA or a 401k or 403b during the year, or got some pension money coming in, if you don't get a form at the end of the year showing what you had taken out during that year, give a call to whoever manages the plan and ask them for it, because you're gonna need it. You're gonna need it for the tax returns. And to not get too on a tangent too far off, I should mention one other type of 1099, which might be popping up a lot more in the next couple of years, just to make people aware of it. It's called a 1099-K as in kite. The reason I'm mentioning this is folks who hadn't got any of those before are starting to get them more frequently. And next couple of years, it's going to be more of an issue. People get these like, what the heck is this 1099-K as in kite? If you get money paid to you by what's called a payment settlement entity, what is that? Think PayPal, right? Or Venmo, even credit card companies. If these organizations send you payments, right? They transfer money into your bank account, usually is how it goes, but it could be sending you a check, theoretically. They send money to you. For 2025, if any one of these sent more than $2,500 to you, so PayPal sent you $2,501 in the year we're in, right? They're supposed to report that to you on a 1099-K and say, hey, we paid you this much money. And they also send that information to the IRS, right? If you disregard that or don't get the 1099-K, well, if the IRS has that data and you go to file your return, there's a good chance the IRS computer's going to go, we got this return here, and we know there was this $2,501 this person got, but there's nothing on the return that seems to match it. You'll get this kind of automated letter saying this whole process where the IRS is going to be like, hey, explain, what this was for, or we think you owe tax on it. It's called a 1099-K. In the past, very recent past, it was like you had to have over $20,000 for this to trigger, right? And multiple transactions. Well, 2025, it's dropping down to just $2,500. You get over that from one entity, boom, you should get a 1099-K, and they're going to report it to the IRS. And next year, 2026, that amount is being dropped to just $600. So next year, if you get $601 from Venmo or PayPal, they're supposed to send you a 1099-K to use in your tax preparation and report that to the IRS. And where I can see this, if you like to tinker, I like to tinker with things, right? I'm always fixing stuff, um, engines, mechanical things, doing stuff like that. Well, say you start doing that as a little hobby, you're retired and you do that and you sell some things online on eBay or some of these other sites, right? And you get this money paid you through these payment settlement entities, right? Well, you've been doing it, for a few years, but these requirements are when that payor, the PayPal or Venmo, the requirements for when they have to send data to the IRS and send this 1099-K, because that requirement is getting tighter and it's a smaller dollar amount, from the previous years to this year and even next year it drops. You might be doing the same old thing this year or next year that you've been doing for a few, but because these rules changed, all of a sudden, now they got to report to the IRS how much you got in payments from whatever this business you got going, or it's hobby, and you're going to get a 1099-K. I'm just mentioning it without getting to all the details on it. Just be aware of that's what this thing is, 1099-K. If you get one, don't dismiss it, and they're going to be more common in the future. I'll stop it there because, like I said, there's like 20 some 1099s out there, but that's just something to be aware of. On here, we're talking about there's a form 1040 SR, and that's just a tax form, federal tax form. And how is it different from the normal one? Well, basically, there's a larger print. It's easier to read and write in on it if you're going to handwrite it. And there's actually what's called a standard deduction table right on the form, which helps you quickly find your standard deduction for your filing status. Those are probably the two biggest things I see for it. We talk about state tax credits. Earlier, I mentioned some credits where maybe you don't have to file, but you actually should. Well, the forms in Michigan for the homestead property tax credit is the MI 1040 CR, and there's a home heating credit, which is an MI 1040 CR7. Those are tax forms to file things. You can sometimes get other forms from the government. Just keep an eye open, anything tax related. Usually a good way to do it is throw it into a folder during the year. And at the end of the year, just open it up, give it to your tax preparer. But that's probably all I'll say about this. I don't want to go on too long, take too much time on this point, because I know we're talking about other things. I don't know, RG, got anything you might want to jump in on? If not, I'm probably good. I think that's what I want to speak on for this point.
No, but I'm glad that you brought up the 1099-K. That is really, it's an important thing to note, especially now that the thresholds on that reporting are being lowered. So that is something that people who have not received those in the past may start receiving them, and they need to understand what will happen with if there's mismatch in reporting between whether or not they file a return and then what the IRS knows or is reported to the IRS. Moving on to the next slide, I Thomas covered pretty well, I think, some of these withholding and estimated tax issues. But retirees and seniors commonly receive, as Thomas had said, they receive distributions from retirement accounts and pension payments, and those are often taxable. And each year they'll receive a 1099-R reporting those distributions. And one of the things to do in order to avoid owing taxes when you file is that the taxpayer yourself may want to instruct the payor to withhold money from these accounts. Now, sometimes, like what Tom said, um, sometimes they withhold automatically, and a lot of times it's 10%. You got to be aware that that withholding may occur, but there are also times where you yourself may want the distributor or the payor to withhold, and there is a way to instruct them to do that. And Thomas is going to talk about the form that is commonly used to do that, and that is the form W-4P.
Thanks, RG. So this form W4P, that directs the withholding on retirement account distributions from pensions. The P is for pensions. So if you get a pension and you want to have tax withheld, you can complete this form. We have a little IRS website down there to pull it up and send it in. The form's pretty short. It's one page of extra stuff you fill out, and there's some instructions that go with it. And at the top, it's like your name, your address, your social number. And then there's some a section 2 with some special situations, like if you have multiple pensions, you can fill out that, or if you have dependents and things, you kind of walk through just a few questions about special situations that might affect how much you want withheld. And at the bottom, there's a couple of lines. One of them is you can have extra amounts withheld, right? What's a short form is the point. It's pretty quick. You would, not only you just fill it out and send it to the company that administers the pension. And then they will apply their some formulas to it, and then you'll have an amount being withheld on your pension payments going forward. And the reason you do this, here's something a couple of people right now I'm helping with, and over the years, quite a few. You retire, you get your Social Security benefits, but maybe you have a pension from a company, taxable pension, right? If you don't have withholding on that pension, and say it's large enough, right? You can actually run into a situation where all of a sudden you got your retirement benefits, your pension's big enough that now your combined income, think about earlier, we were talking about, if you have combined income, you have to file. Now your pension, taxable pension is so great that your combined income is making some of your Social Security taxable. And if you don't have withholdings on the pension, right? You go to file your return and you're going to owe money. I've got folks that come in every year. They have this situation where they got this pension money being paid. It's taxable. They don't have any withholdings. It causes some of their Social Security to be taxable, and the pension becomes taxable. And there's no tax withheld, right? So now they owe every year. It goes on year to year to year, and they finally reach out and go, "Hey, what? I need help dealing with all this IRS tax debt. What do I do?" And we look at it, and it's like, "Oh, well, this is what's going on. Your combined income every year means you have to file, and some of your Social Security is becoming taxable because you made enough that you've gone to the certain category, these thresholds for what's taxable. And in order to fix it, you need to either at the end of the year pay the IRS the money you owe, or start doing some withholdings. And that's like, well, how do I get the withholdings going? Well, if it's a pension, you use this form W4P, you fill it out, and you send it to the company that administers the pension. Don't send it to the IRS. It's not going to do anything there. You got to send it to the company that deals with the pension. I got to mention there's also, a choice. Say you have Social Security benefits like retirement or disability, and maybe you have a pension also. You can also, if you want, have withholdings taken out of your Social Security benefits. It's a different form. It's not written on here. It's a form W4V, as in voluntary, for withholding. It's called a voluntary withholding request. You can get the form on paper from the Social Security office and send it in. On that one, it's really simple. You just basically check a box, and you have to pick a percentage of your benefits to be withheld as federal tax. And the category, the levels they have, I think 7%, 10%, 12, or 22%. Those are just the options. If you have my Social Security account with the Social Security Administration, you can also go in there and you can change it through your online account. But I want to mention, you can do it either way. I mean, if you have a pension and you have Social Security and you need to do some withholdings, you don't have any, you can do the form W4P, send it to the pension company. Maybe that's going to take care of it. You'll have enough withheld. You can also go over to your Social Security benefits and do the form W4V as in voluntary, and have money held out of your Social Security benefits. And then what you do is you do either or both, depending. good to talk to a tax person if you need help with it. And then you see how much is coming out and is it enough? And you might have to adjust it a little bit going forward. So, you don't really want to have too much taken out. But you want to really make sure you don't have too little, because then you end up with a tax bill at the end of every year. And we have folks that come in and they just have no withholdings, nothing being taken out, and they end up owing every year, and year after year after year, $2,000, $3,000 owed every year. That starts adding up. And in order to get out that cycle, well, you got to get some withholdings going on. These are the two main forms that I see with the retirees. And then, of course, it'd be good to talk to someone like RG or myself or one of our peers to deal with the debt that's owed, the tax debt. But you got to get off the cycle. Otherwise, it's just going to keep going. So it's important. This one I mentioned form W4P, that's for pensions, and W4B as involuntary, if you want to have withholdings taken out of your Social Security retirement or your Social Security disability benefits.
All right. Thank you, Tom. We're going to move on to just a couple things about retirement account withdrawals. And there's two things to consider when you're thinking about retirement account withdrawals. Um, and this is in addition to what Tom was just talking about, which is making sure that you're comfortable with the withholding amount on those withdrawals. The first thing is that you can be penalized for taking money out too soon. The second thing is you can be penalized for taking money out too late. And so there's the early withdrawal penalty that if you take money out of your retirement account before age 59 and a half, you could be subject to a 10% early withdrawal penalty. Now, there are certain exceptions to that, depending on your circumstances, because Congress recognizes that there are emergencies or unanticipated things that might happen in a person's life where they need to take money out of a retirement account before they were supposed to. That would be something to talk to someone like me or Tom about, or your tax return preparer about. The other way that you can get into trouble is if you allow money to build up into your retirement account indefinitely without taking that money out. And there is a temptation there for some people, depending on their financial situation, is to leave money in those retirement accounts and let it to continue to build tax free in those accounts. And the government does not want you doing that. And so there is starting at age 73, there's these required minimum distributions that if you do not take them out and pay tax on those accounts, you could be subject to a penalty. The So those are the two things to think about when it comes to retirement account withdrawals. A few other things to think about, and I think here in a minute, Tom is going to talk about scams. But just one thing to mention first is if you want more guidance for specific issues that you may be having as a retiree or senior citizen, the IRS does have a publication 554, and that addresses many of the issues that retirees face, including life insurance, how proceeds are taxed, how surrenders are taxed, the sale of your home, reverse mortgages, and those are just a few of the issues that you can see addressed in that. And I'm going to hand it now back over to Tom to talk a little bit about scams before we wrap up our presentation.
All right, so scams. You could have it slide after slide after slide, all the way scammers try to get you, right? It's insane. They're always finding new angles. But a couple of things to mention in general, that criminals impersonate IRS employees and they call taxpayers. But you know what? The IRS almost always contacts people by mail. If you get a call on the phone or a text message or an email saying, hey, this is the IRS, you owe this money, it's probably a scammer. Now, there's very few exceptions. Like, if you owe a bunch of money, maybe a local IRS agent in a field office that's going to go out. They normally, go to the door, knock, and leave their card. But the scammers will call up and be like, hey, this is the IRS. And they try to use like threatening language and try to get you scared. They want to get you kind of rattled a little bit to then get whatever they're seeking, whether that's just trying to get your personal information so they can file a fake return and try to create a fake refund and steal it and then leave you hanging when the IRS figures out there's a problem. Or maybe in some cases, they're going to sell that data on the web and people use it to work. And then you start getting notices from states you never lived in that you owe that state, and the IRS is talking about this income that wasn't on your return. That happens sometimes too. You know, the thing is, if you get something out of the blue, especially if it's a phone call or a text message or email, and they're trying to like get you rushed, or you got to make a payment right now, or threatening language or anything like that. Hey, you know what? Hang up. Don't answer the text. Don't respond to the email. If you're really concerned about it, just get the legitimate number for the IRS and call them up and talk to them, and they'll let you know, right? And they're probably gonna say, no, that's not us. You just gotta be aware of it because we have good days and bad days, right? And you say, oh, I'll never get scammed. But then you have an off day. You didn't get enough sleep. You're up late. You're out doing stuff. Maybe you're out in the sun all day long doing mowing, whatever, right? And they try to catch you in that off moment, get you rattled, and get that information, do whatever nefarious thing they want to do. So just be aware of it. IRS, they love letters. IRS loves letters. Virtually all my clients, I think with the exception of one person that I'm thinking about right now that I'm helping, it's letters that were sent. And guess what? If you'll get letters, a lot of them before a person like a field office agent goes out if you owe like hundreds of thousands of dollars, right? So be aware of this. Scammers are out there. They're always trying, and you might not be subject to it and not fall for it a bunch of times. It only takes once. And it's a big headache to unwind. Again, I wanted to mention something earlier. Actually, we're going to talk about what's called ID.me and the IP pins. ID.me is a third-party company that the IRS uses to verify who you are. So if you were to sign up for an IRS account online, like say sign up an online account with the IRS, so you can try to online get this what's called the IP pin. They're going to run you through this company called ID.me, and they're going to want to see like images of your driver's license, probably your social security card. They have all these other documents they can look at, passports, recent utility bills, things like that. And then if they're good with all that, and they do a scan of your face, kind of almost like a science fiction thing. They look at you and they have a program that runs your image compared to the picture ID you show them with other documents. And if they verify it's you, then the IRS will let you set up an online account. Sometimes you go to set up an account with the IRS and you do all this, and ID.me is going to want to do a video chat with you. And the reason they hire them is ID.me specializes in verifying people's identity, and the IRS wants to make sure it's you that's trying to do an online thing with the IRS. And ID.me is used for a bunch of other government agencies and I think some private entities as well. But just be aware, ID.me is legit. It's tied to the IRS for verifying people's identities. And if you do get an account with the IRS online, you can go to your online account and ask for an IP pin, or you could call IRS or download it. Just type in IP pin in Google and find the irs.gov site, and the forms will be there. And you can request this PIN number, which we talked about a bit earlier, so I won't go into all that depth. But it's a number, once you apply for it, IRS sends it to you every year, and you got to have that number to electronically file. Right? If you were to get the number and lose it, you can still file, but you have to mail your return to the IRS and go through extra scrutiny. The benefit really is that if you have you sign up for IP pins, the scammers aren't going to have that. All right. And then the scammers want to e-file. They want to get in quick, electronically file. Usually it's like putting a bunch of fake information on the return and sending that refund off to some bank that specializes in like debit cards for refund anticipation loans or things like that. And they kind of launder the money and kind of get it away, right? Scammers don't want to fill out a paper return and mail it to the IRS. So if you have an IP pin and say a scammer does try to e-file, well, it'll be rejected and they're just going to move on to the next target. It's a good thing. And actually, RG, you can see if my recollection is correct, but I think the IRS even past few months has said they would like all taxpayers to get IP pins. I think it's in one of their news or press releases because there's so much tax fraud and so much scamming going on. So
Right.
something to think
Yeah,
about.
I think that's right, Tom. It is a really good idea. I know that in my tax practice, and I'm sure you see it in yours, is there is so much more scams going on. And what I have noticed in my own practice is that those scams are often targeted towards retirees, senior citizens. One of the main reasons for that is because it is very common for retirees and senior citizens to have a pretty sizable nest egg. If things have gone well for them in their careers and their earning years, they will have saved up money, and those obviously that money is for their retirement and other needs. And but unfortunately, the result of having that money is that they are a target um, for scammers. And Tom, did you have anything else to present on that slide, or do you want me to wrap it up?
And I think that's probably the main point. I mean, you can talk about all different scams. I just want to drive home that, hey, the IRS sends lots of letters. Look for the letters. You get a call, a text, an email, hang up, don't respond, and you can call the IRS and confirm it's them. Um, just don't fall for it because once they get you talking to them, and then they try to get you rattled or get you off game, all of a sudden they get the information they need from you, click, and they're gone. Or maybe I know someone who fell for this, and what the person transferred money, went down to the store, Western Union, sent some money to pay, stop the IRS from going after them. Talking five figures, gone. Right? It happens. It happens. So I just want to say, you got someone that's the IRS is going to send you a letter. If you get communication some other way, don't respond. You can call the IRS directly to see if it's legit and you have an issue going on. So that's the main point I wanted to drive home.
Well, very good. I think that's our presentation for today. And Tom, thank you so much for co-presenting with me on these are really important topics. And if you are a taxpayer and you're facing tax problems, whether you're a senior citizen or a retiree or anyone, you can reach out to me or Tom at the contact information in this slide. Tom again is with Legal Aid of Western Michigan, and I'm with Legal Aid of Arkansas. Each one of us is our respective low-income taxpayer clinics there. So, and with that, I'm going to end it. I thank everyone for the time. Thank you, Tom.
All right. It's been a pleasure. And thank everyone for taking the time out of your day to hear us talk about tax things. Thank you very much.